Hi, good afternoon, good morning, wherever you are. So today we are going to be doing advanced audits for those taking the ICA and those taking the ACCA as well. So please take and stay with me. This is going to be the first session. It's going to be interesting. I'll break down everything for you to understand, and you should be able to pass your exams with ease. Like I always say, if you haven't subscribed, just subscribe so that anytime I post a lecture or a video, you would be able to, get notified for the video. Okay, so let's dive right into it. So today's objectives, we'll be talking about the meaning of audit and assurance. What exactly do we mean by audit and assurance? We want to understand the meaning of it. It's important to understand it. Then number two, we'll be talking about the regulatory environment. Number three, we'll be talking about the rights and duties of auditors. And the last one, we'll be talking about other issues, any other little issues that we can discuss to end the lecture. And so let's dive into the meaning of audit and assurance. So when we talk about assurance, right, just think about the word. The word is not a complicated word. So when you are giving someone assurance about something, it basically means that you are giving them comfort. You are giving them comfort. Assure me that you will pay this money. Basically means that, give me some comfort that you're actually going to pay me this money. So first of all, think about it as a normal English word, and you'll be able to understand what it means and how it relates to audit. So in an assurance engagement, a practitioner is engaged by one party to give an opinion on a piece of information that has been prepared by another party. So basically, in an assurance engagement, the auditor, or whoever is, engaged to give an opinion is given comfort over the financial statement that is prepared by management. So basically, there are three parties here, right? There is the user of the financial statement, there is the auditor, and there is management. Management prepares the financial statements, right? The external users, they are going to use the financial statements. But if management prepares it and budget publishes it, what shows that the numbers, they are correct? Anyone can come up with some numbers and say their revenue is 5 billion. It doesn't mean it's correct. So we need an assurer, someone who will assure us that these numbers are actually okay. These financial statements are actually okay. That's when an auditor comes in. So an auditor will be like the middleman who will give that assurance, who will give that comfort. And the auditor does that by giving what we call an opinion. So they give an opinion and say, hey, you know what? We've looked at these financial statements and we think they are okay. Or they might say, we've looked at these financial statements and we think these are the issues. So the opinion is basically an expression of assurance or comfort about the information that has been reviewed. It's just you giving a comfort, like I always said. So very, very important. Keep that in mind. First, understand the meaning of what assurance is, and you'll be able to apply it to whatever an audit means. So let's move on to talk about statutory audit. Since we've talked about assurance, let's move on to talk about the statutory audit. Okay, so a statutory audit is a form of assurance engagement. When you're auditing, you are given assurance. That's very, very important to understand. So the statutory audit provides assurance about the quality of information. It gives credibility to the financial statements. So it makes the financial statements a lot more reliable, so it makes it a lot more dependable, because if I know that there's an auditor who has checked the financial statements, I can basically rely on it, based on the opinion the auditor gives. So a statutory audit is a form of assurance engagement. That's why you see for a lot of big four companies, they'll see audit and assurance services as one of their service lines, So because of the amount of work that is performed on a statutory audit, right, a reasonable or high level of assurance, it gives a reasonable or high level of assurance. That's very, very important to understand. And the reason why we talk about reasonable level of assurance is that one of the things that happens in audits a lot is because there are so many transactions that happen in a company within a year. One of the tools that auditors use is sampling. They do not test every single transaction. It's impossible. If you look at things from a cost-benefit perspective and time constraint perspective, you can't test every single thing. So basically what they do is they sample, and because they sample, they make an opinion basically on the sample, on the sample, but the sample must be representative of the population, basically. But they do not test every single thing. And that's why they give a reasonable level of assurance based on the work that they've done. You need to know that other assurance engagements may provide a limited level of assurance to the person receiving the opinion. So there are other assurance engagements that we'll be talking about, and those give a lower level or a limited level of assurance. The level of assurance that is given also depends on a lot of factors which we'll be going into later. So this is what you basically need to understand. What you need to take out from this slide is that, first off, what is assurance? Assurance is basically giving comfort, giving comfort. And you give comfort by giving an opinion or expressing an opinion about the information that you review. And that's what basically auditors do, right? They give assurance on the financial statement that has been prepared by management. So they come in and say, oh, we've checked everything, we've checked this and it looks fine. Then it gives credibility or adds credibility. And that helps to preserve the integrity of the capital markets. So if you look at it critically, right, because the users will be dependent on this information, so they need someone to actually review. It's only fair to do that. So please get that clear in your mind. So let's look at some examples of non-audit assurance engagements. Non-audit assurance engagement. So examples, it might include reports on things like corporate social responsibility. Corporate social responsibility is one of the themes that is really, really rampant these days. Companies are talking about it. Companies are not only focusing on just generating profit, but being beneficial to their society. Things like environmental policy, non-financial performance indicators. If you are taking the strategy exams, you realize that one of the models that is very, very prominent there is the balance scorecard. The balance scorecards look at the performance of the company holistically, right? And it looks at things from a financial and non-financial perspective. So you are not only looking at the company from a financial perspective only. There are other non-financial things that add to the performance of the company. So these are examples of non-audit assurance engagement, like CSR, corporate social responsibility, environmental policy, employment policies, non-financial performance indicators. These are all non-audit assurance engagements. Assurance engagements also have become very significant in recent years. Why? Because of the increase in the range of information provided by company directors in reports to shareholders. The range of information that is being provided these days is very, very huge, because users are demanding a lot more. Users want to see a whole lot, they want to understand deeper the numbers, and when you want to go to that extent of depth, right, assurance engagements become a lot more significant. That is very, very important to understand. So let's talk about the elements of an assurance engagement. What are the elements of an assurance engagement? What are the elements of an assurance engagement? An assurance engagement has 5 elements, 5 key elements. Number one is that it's a 3-party relationship. It's a 3-party relationship. So there's a practitioner, there's a responsible party, and there are intended users, the practitioner, the auditor. And there's a responsible party, the person who's responsible for preparation of the financial statements. And they are the intended users. They are intended users. So you have these 3 groups of people. And so it's a 3-way relationship. Always remember that. It's like a triangle. It's a 3-way relationship. This is the first element. The second element is the subject matter. Every assurance engagement has a subject matter. What exactly are you doing with this assurance? What's the purpose? What's the purpose? And we'll be diving more into that in the next slide. Then every assurance engagement should have a suitable criteria. The criteria provides a guideline as to how you perform the assurance. It gives you a guideline. So you know that based on these guidelines, you are performing or engaging in this assurance activity. The next one is sufficient and appropriate evidence. Sufficient and appropriate evidence. Before an auditor is able to give an opinion, there must be evidence. The opinion is not just a subjective thing. It's not like a baseless thing. It has to have a base. So you don't just wake up and say, oh, I've given an opinion as an auditor on this financial statement. These financial statements are very good. On what basis? On what basis? And that basis is the evidence. The evidence must be sufficient and appropriate. Sufficient and appropriate. So when you think about sufficiency and appropriateness, you're thinking about quality and quantity. Sufficient is in terms of quantity, appropriate is in terms of quality or relevance. So it must be sufficient and appropriate. Sufficient and appropriate. Very, very key. Sufficient and appropriate. So you need to, have that at the back of your mind. When you're giving an opinion, it must be based on evidence. Evidence. You don't just give any opinion. It must be based on evidence. And the last element is that it must be an assurance report. It must be a reportage. It must be formal. Okay, this is what we are talking about. This is what we audited, and these are the results that we got from this audit. So it must have an assurance report. There must be an assurance report. It's very, very key. So number one, three-party relationship. Number two, subject matter. Number three, suitable criteria. Number four, sufficient and appropriate evidence. Number five, assurance report. So let's talk about audit and audit-related services. Audit-related services. Number one, what is an audit? And what is its purpose? Basically, we've talked about this in previous slides, but let's gist about this a little bit. So the purpose of an audit is to enhance the degree of confidence of intended users. Enhance the degree of confidence. You want people to confide in the financial state. You want them to have confidence in the financial statement. So the audit opinion makes reference to whether the financial statements give a true and fair view. You would hear this term a lot in your audit books or your audit lectures, a true and fair view. You need to make reference to whether the financial statement give a true and fair view of the financial position of the company, of the financial position of the company. So audit gives confidence. Audit makes sure that the financial statements that are being presented give a true and fair view of the financial position of the company. So if the company says in its balance sheet that it has a cash balance of $1 million, you actually want to be sure. You actually want to be sure as an auditor that they have the 1 million. So basically, that's what giving a true and fair view means. Then the next one is review. A review provides a low or moderate level assurance that the information under review is free from material misstatements. You're basically given a moderate level of assurance. It's not high. Remember that in audit, you are given a high or reasonable level of assurance, as we talked. In the review, you are given a moderate or low level of assurance that the information you are reviewing is free from material misstatements. It's not free from misstatements, but free from material misstatements. Very, very important. So the concept of materiality is something you need to understand. So for instance, when we say something is material, it means that its omission or misstatement will significantly influence, users' decision on the financial statement. So for example, if you have a huge company like, let's say, MTN, or let's say Microsoft, right? If Microsoft doesn't record a $1 pen, The $1 is not material to them because they are making revenues in billions of dollars. So materiality, we are saying that the information under review is free from any material misstatement. Any material misstatement, not just misstatement, but any material. The misstatement has to be material. So if it's material, it means that it will affect users' decision on the financial statement if it's omitted or misstated. So the accountant's opinion in this case is usually expressed in the form of negative assurance. So when we say negative assurance, it's basically an opinion that there's nothing obviously wrong in the information. You are just saying that, oh, there's nothing really wrong here. If you review, then you don't see anything wrong. That's a negative assurance. Then you move on to agreed upon procedures. Agreed upon procedures. This is where the client, right? The client hires the accountant and specifies the procedures that should be followed in performing the engagement. So there's some sort of agreement on what procedures to perform. So the name itself explains itself, it's explanatory. These are adopted in an engagement where the client hiring the accountant specifies the procedures that should be followed by the accountant in performing the engagement. So there's some sort of agreed upon procedures. Okay, you do A, B, C, D, and it's agreed upon. Then you have the compilation. The accountant is engaged to prepare information for the client. It's more preparatory. You are preparing more about preparation. You are preparing information for the client rather than audit or check the information prepared by someone else. So here you are more focused on preparation rather than auditing or checking information. So a typical example is computing tax. And so no assurance is provided in a compilation engagement. You are basically preparing information for the client, just like what you do when it comes to tax computation. It's a compilation engagement. And in compilation engagement, you do not give assurance. There's no assurance given here. Very, very key. Please let that stick in your mind, please. Then let's move on to the need for regulation. Audit is a huge profession, and there's a lot of public interest involved. People depend on financial statements. So obviously there has to be regulation. Obviously, you need regulation. Very, very important. You need regulation. Very, very key. You need regulation. So the key reason why audit and assurance services should be regulated is to serve the public interest. Anything that involves the public has to be regulated, so that if someone messes up, we will know exactly who to go to. Assurance providers are supposed to give an impartial view, an objective view, or a professional view on the issues that matter to users of financial statements. You must be able to give that. You must give an impartial view, That's why the auditor is like a third party. You should have no interest, You should have no interest. And later I'll be talking about the different interests and threats to audits. So he should have no interest. Otherwise, if he has an interest, he can give a faulty opinion. So assurance provided are regulated by the law of the land. The law of the land regulates them. Ethical standards also regulate them. Ethics, what is morally right, what is morally wrong. And the professional body to which they belong. The professional body also regulates them. So these are three things that regulate, assurance providers. So I talk about assurance providers are given ethical guidance by professional bodies. This is where they get the source of their ethics from law and from basically the International Federation of Accountants. This is a body that kind of oversees accountants. So that's the need for regulation. We need regulation to protect the public interest or to serve the public interest. Please keep that in mind. That's why we need regulation. And you can get this regulation from the law of the land, from ethics, and from professional bodies. Very, very important. So let's talk more about the need for regulation. The need for regulation, right? So most countries have legal requirements associated with assurance providers, particularly auditors. Most countries, right? And so examples in Ghana, you'd have the Companies Act, the Bank of Ghana Act. These are all legal requirements that sort of regulates the activities of auditors. So they kind of like shape, or give some legal framework or regulatory framework for assurance providers and auditors. Very, very important. Very, very important. I'm sure at this point you might be asking, since there is a lot of regulation and legality when it comes to assurance provision and audits, what are some of the requirements? How does appointment of auditors work? How does it work? That's a great question. How does it work? How does appointment of auditors work in Ghana? Let's use Ghana as a case study. So no person, right, shall be appointed as the auditor of a company unless they have consented in writing to be appointed and are duly qualified. So two things must happen here. You must be duly qualified, obviously. You can't just wake up and say you are going to audit someone. You must be credible. You must qualify. And also you must consent in writing, that you've accept that you audit this company. You must consent in writing. You must consent in writing. So in Ghana, a person is only qualified for appointment as auditor of a private or public company where they are a member of the ICAG under the Chartered Accountants Act 1963. So a person is only qualified for appointment as auditor of a private or public company where they are a member of the ICAG, a member of the ICAG. A person may also be the auditor of a private company where they are a practicing accountant. So you may be the auditor of a private, very, very key, not public, private company where they are a practicing accountant within the meaning of the Chartered Accountants Act. Please take note that it says private. A person may also be the auditor of a private company where they are practicing accountants. So very, very key. Appointment of auditors, two things must happen. You must consent in writing and you must be duly qualified. Please take note of that. So who are the people that are not qualified? This is all in relation to regulatory environments. Who are the people that are not qualified? An officer of the company or of any associated company, right? So for example, if you're auditing company X, the auditor cannot come from company X, because there's some bias there. Obviously there's some bias there. You wouldn't want an auditor who is coming from the company from within your company. There's no objectivity there, basically. So for example, that's why the auditor must be independent. He must not come from within the company that's been audited. He must be independent. Another thing is people are unqualified. A person who is an infant doesn't qualify to audit. If you're an infant, you can't audit, obviously. Just like a lot of the laws, if you're an infant, you can't do this. A person who is a person of unsound mind, a person who is not mentally stable, cannot audit. A person found by a competent court to be a person of unsound mind cannot audit. These are very, very important injunctions that you need to understand. A person who is an undischarged bankrupt. An undischarged bankrupt. So what do I mean by undischarged bankrupt? Basically, when you go through bankruptcy, there are certain procedures that you need to go through to when you are going through the process of bankruptcy. So if you haven't gone through all the processes, you are undischarged from bankruptcy. And so an undischarged bankrupt is not fit to audit. It's not fit to audit. Unless he has been granted leave to act as an auditor of the company concerned by the court, unless the court gives the person permission then they can go ahead to audit. So an undischarged bankrupt can not audit. They are not qualified. They are not qualified. They are not qualified. So these are very, very important things that you need to understand. Not anyone can just wake up and say, I'm going to audit. Not anyone can say, I'm just waking up to go and audit. So an officer of the company, not qualified. A person who is also a partner of or in the employment of an officer of a company, Basically, if you have ties to the company you're auditing, you are not qualified, right? You need to be totally independent, because here you are trying to give an impartial view. So anything that, gives you ties, to the company you're auditing, it affects your independence. So one of the things that is key in audit is auditor independence, where you want to make sure that, the auditor does not have any ties with the client that is auditing. The auditor has to be as objective as possible in to be able to audit fairly and impartially. Then there are other things to note. So how is the appointment done? Auditors shall be appointed by what we call an ordinary resolution. So when we say an ordinary resolution, it's just simple majority, which is 50% plus 1. So auditors shall be appointed by ordinary resolution of the company and not otherwise. However, there are two exceptions, right? The directors may appoint the first auditors of a company and may fill any casual vacancy in the office of the auditor. So two exceptions here. The directors may appoint the very first auditors of the company. The directors are given, the freedom to appoint. And if there's any casual vacancy in the office of the auditor, the directors can appoint. But the auditors generally shall be appointed by the ordinary resolution of the company and not otherwise. And if a company, for any reason, has no auditor for a continuous period of 3 months, the registrar may appoint the auditors. If they are for 3 months, 3 months is too long, that's 90 days. If they have no auditors, then the registrar may appoint auditors on their behalf. Very, very key. Very, very key. I hope it's becoming clearer and clearer in understanding exactly how all this works, right? I'm sure it's becoming a lot clearer. And stick and stay with me. You should pass this exam with ease once you follow me step by step. You are definitely going to pass this exam. So every existing auditor shall continue in office. They shall continue in office unless they cease to be qualified. One of the key things to audit is qualification. Qualify. You need to qualify. Another reason why the auditor might cease to continue in office is that the auditor resigns by a notice in writing. So you can't just wake up and say, hey, I'm off. You need to resign by a notice in writing. If you resign by a notice in writing, then you can go. Then the same way an ordinary resolution can be used to appoint auditors, an ordinary resolution can also be used to remove auditors at an annual general meeting. At an annual general meeting. Very, very important. Very, very important. So at an annual general meeting, an ordinary resolution can be passed and say, hey, we remove these auditors. And an auditor shall continue in office until any casual vacancy occurs as well. So you need to keep in mind, if he ceases to be qualified, if he resigns, or an ordinary resolution removes the auditor. Then I write an interesting thing here. It says, when the auditor is appointed by the directors or by the registrar, remuneration of the auditors may be fixed by the directors or the registrar, you know. And this shall be fixed by an ordinary resolution. So an ordinary resolution is very, very important. So if the auditor is appointed by the directors or by the registrar, then what does it mean? Then their pay, their compensation also is also fixed by these parties, and it's fixed through an ordinary resolution of the company. Very, very key. Very, very key. So it's in the form of he who appoints you, kind of like decides, you know, your pay, kind of, or compensates you. So once the auditor is appointed by the directors or by the registrar, their remuneration, the remuneration of the auditors may be fixed by these parties. Very, very key. Something to keep in mind. Something to keep in mind. Then let's delve a little bit more into removal of auditors in Ghana. Removal of auditors. In Ghana, a resolution to remove any auditor or appoint any other person in their place is not effective unless it is passed at an annual general meeting. So you just can't wake up and say, hey, I've removed you. It must be passed at an annual general meeting. Very, very key. Just think about it that way. It must be passed at an annual general meeting. And written notice has to be given to the company of this intention. You know, written notice shall be given to the company of this intention. So there must be some written notice. So these are kind of like the procedures for removal of auditors. And the company shall also give its members notice of such resolution. You know, you must also give your members, you know, the notice of such resolution. So very, very key. Very, very key. There are a lot of nuances and details around the days and the number of days that you need to give this notice and all that. But these are things that you can always read. So what you need to understand is the removal of auditors has to be passed within a certain environment, which is at an annual general meeting. And there must be a written notice for this. And also, the company shall give its members notice of such resolution. You know, so there must be an AGM, and you must basically notify members of such resolution. And this must be written. Very, very key. Very, very key. So that's how you remove an auditor. And don't forget that we talked about removing an auditor through an ordinary resolution. But this ordinary resolution has to take place at an annual general meeting. Very, very key. Then you have the resignation of auditors. The auditors also may choose to resign. They don't have to necessarily be removed. So they also may decide that, hey, we are off, we are going. We are going. And there might be several reasons to this, right? One of the key things that may cause auditors to resign is a lack of integrity. If a lack of integrity is demonstrated by management or those charged with governance, the auditor can easily resign. Integrity, integrity, integrity. Please keep that at the back of your mind. As you go through audits, as we go through these audit lectures, one of the things that will keep on coming is management integrity. Management integrity. So a consistent lack of integrity is demonstrated by when a consistent lack of integrity is demonstrated by management, the auditor may resign. Also, when significant fees remain unpaid, when there are money issues, they are not getting paid, they must also leave. When the audit firm can no longer maintain its independence, remember we talked about auditor independence, which is very, very key. It contributes to the impartiality of the auditor. The impartiality of the auditor. And so when the auditor feels that I'm no longer independent, I'm associated with this company in some way, it will have influenced my opinion on this financial statements, they will resign. And there are situations where when the client is no longer profitable for the audit firm, they also may resign. In Ghana, any auditor who resigns must give notice in writing. Must give notice in writing to the company. You must give notice in writing. So this is very, very important to understand. Then let's talk about the eligibility to act as an external auditor. So the audit profession is kind of like regulated, right? As we talked about, it's regulated. So the eligibility to act as an external auditor is usually determined by membership of an appropriate regulatory body, like the ICAG Ghana, when it comes to the Ghanaian context. And what is the role of these bodies? The role of these bodies is basically offer professional qualifications for auditors, you know. So like this ICA you guys are pursuing or might be pursuing, or ACC or whatever it is, what they are seeking to do is they are providing a professional qualification. And this will provide evidence that auditors possess a minimum level of technical knowledge or technical acceptance. You need to show that as an auditor, it's like just like the medical profession, you need to show that you have some professional qualification. It's not for everyone. You know, it's not for everyone. So that's the purpose of the professional qualification. Then also these regulatory bodies like the ICA, these professional bodies, they establish procedures to ensure that the professional competence of auditors is maintained. You know, there are ways and means they ensure that the professional competence of auditors is maintained. So a typical example is what they call CPDs, continuing professional development courses that you constantly need to take to keep yourself abreast of the issues that are happening in audits. You know, so that's what they ensure. They try to let their people, those who are taking the exam, understand that, you know, they have to be updated. You know, things are changing, things are moving in the audit world. So you have to be updated. You have to be updated. Very, very key. You have to be updated. Very, very important. So these regulatory bodies, give eligibility, you know, to the external auditor in these ways. They provide professional qualifications, and they also establish procedures to ensure that the professional competence of auditors is maintained. It's up to standard. It's top-notch, you know, top-notch. Very, very key. Then let's talk about the rights and duties of auditors. The rights and duties of auditors. So today we'll just focus on the duties of an external auditor, and we'll talk about, in subsequent videos, we'll talk about the rights of an auditor and other matters as well. So what are the duties of an external auditor? The primary duty of an external auditor is to examine the financial statements. And issue a report on the financial statements. So the auditor's report will say something like, these financial statements give a true and fair view or present fairly the financial position and performance of the company and have been prepared in accordance with the applicable financial reporting framework. Remember, we talked about a suitable criteria, you know. Here is saying that the financial statement have been prepared in accordance with the applicable financial reporting framework. That's a suitable criteria. A suitable criteria. Always keep the elements of an assurance engagement in mind. That's the foundation to understand assurance and audit. So the primary duty of the external auditor is basically to examine the financial statements and also issue an auditor's report on the financial statements and give an opinion. What is the opinion based on your review of the financial statement? What is your opinion? What is your opinion? And so basically, this is where we would end today. In subsequent lectures, we'll be talking a lot more about the rights of auditors, etc. And please take and stay with me. Just hit the subscribe button, hit the notification bell, and everything you need to pass this exam, I'll just be offloading it to you. All you need is to watch the videos and, you know, review your notes, and you should be fine. Thank you very much and have an amazing, amazing day.